Hi, good evening. I hope I am audible to you. Am I clear? Am I audible clearly? Yes. Like I welcome you all for PGBP second session. In first session, we discussed about completely about depreciation. Now we are going to discuss section 35. Remaining all concepts, section 35, 36, 37, section 40 series, section 44 series, all of them will be covered in today's revision. Okay, first we will discuss section 35, scientific research expenditure. Like if you incur any expenditure for the purpose of scientific research, then that expenditure is also allowed as deduction under PGBP under section 35. Scientific research expenditure is classified into two types: in-house scientific research expenditure, contributions or donations. That means within your company, if you do scientific research, that will be called as in-house scientific research expenditure. Like if you cannot do scientific research on your own, even if you give any donation to research association, even that is also allowed as deduction. First I will discuss about in-house scientific research expenditure. In-house scientific research expenditure is allowed only if you do scientific research with regard to your own business. Let's say I am into business of manufacturing of cement. With regard to cement, if I do any scientific research, that scientific research expenditure is allowed as deduction. I am into cement manufacturing business, but I did research on laptops. That scientific research expenditure will not be allowed as deduction. That means whatever the scientific research expenditure that you are incurring, it should be in the same nature of business which you are doing, then only it is allowed as deduction. Now in-house scientific research expenditure, like whatever the scientific research expenditure that is incurred before commencement of business, even that is also allowed as deduction. And after commencement of business, if you incur scientific research expenditure, that is also allowed as deduction. So sir, how much period? Let's say today you are commencing business. Before 3 years, that means from today, in last 3 years, whatever the scientific research expenditure that you have incurred, that scientific research expenditure will be allowed as deduction. That scientific research expenditure can be revenue expenditure and capital expenditure. So like before commencement of business, revenue expenditure includes salaries, material costs, but like only normal salaries will be considered as revenue expenditure before commencement of business. Whatever the perquisites given to employee are there, they will not be treated as revenue expenditure before commencement of business. Next, before commencement of business, for scientific research purpose, you purchased a building. Even that building is a capital expenditure. Now that capital expenditure is also allowed as deduction. Except land, other than land, remaining capital expenditure will be allowed as deduction. The point is, before commencement of business, whatever the revenue expenditure and capital expenditure that you have incurred, all of that expenditure will be allowed as deduction in the year in which you commenced the business. Are you able to understand? But maximum 3 years before commencement of business, whatever the revenue expenditure and capital expenditure that you have incurred, that will be allowed as deduction in the year of commencement of business. Once business is commenced, once business is started, after commencement of business, like all revenue expenses and all capital expenses other than land will be allowed as deduction. Are you able to understand? Land, it's a capital expenditure, but land is not a depreciable asset now. So whatever the capital expenditure on land is there, that is not allowed as deduction under section 35. Not only in-house scientific research expenditure, if you give any donation or if you give any contribution to approved research association or approved university, then whatever the donation, whatever the contribution that you have given to approved research association, either for scientific research or for social research or for statistical research is there, even that expenditure is also allowed as deduction. The point here is only to approved research association, approved college, approved university, if you give donation, then only such donation will be allowed as deduction. Otherwise, such donation will not be allowed as deduction. Are you able to understand? Whatever the donation that you are giving, let's say you are giving donation to one research association, that research association need not be in the nature of your business. Let's say you are doing a business with regard to manufacturing of cement. You gave donation to research association who is doing research in laptops. Still, whatever the donation that you have given, that is allowed as deduction. Are you able to understand? But whatever contribution donation given to approved association, approved university, approved college is there for scientific research, social research, statistical research, the donation is allowed as deduction only under optional tax rates. If SSC is paying taxes under default tax rates, whatever the contribution or donation given to approved association or university is there for scientific research, social research or statistical research, that will not be allowed as. Is it clear? Sale of scientific research asset. See, once you purchase any asset for the purpose of scientific research, then 100% of the expenditure is allowed as deduction under PGBP. For example, in 23-24, like let's say you purchase a laptop for scientific research for rupees 1 lakh rupees. Now what you will do in 23-24 P&L account, total 1 lakh rupees you will claim as deduction in P&L account. Am I correct or not? Now in 24-25 you sold laptop. Okay, you have two options. Option 1, outright sale. Outright sale means what? Directly from scientific research department you will sell the laptop. In that case, whatever the sale proceeds that are received, out of sale proceeds received, to the extent of deduction claimed earlier, it will be credited to P&L account. Balance it will be treated as capital gains. Let's say on outright sale you sold for 1,30,000 rupees. Out of 1,30,000 rupees, what is the deduction claimed earlier? 1 lakh rupees. It will be credited to P&L account. Balance 30,000, it will be treated as capital gains. Are you able to understand? Next, in second case, what you are doing, you are not selling the scientific research asset directly from research department. Okay, scientific research department. What you are doing, you are bringing that asset to normal business, and in normal business you are using it. Later on you are selling it. Here laptop is purchased for scientific research. That laptop, it got outdated. So what you have done, laptop you have shifted from scientific research department to accounts department. In accounts department you are using the laptop. Whenever you bring the laptop from scientific research to normal department, in normal department there will be block of assets. Now laptop will be added to plant and machinery 40% block. Okay, only count increases, it is added at value 0 rupees. Are you able to understand? So whenever it is brought to normal department, in that case it will be added to block of assets, it will be added at 0 rupees. Only count number in the block will increase, and subsequently whenever you sell the laptop, sale value of the laptop will be reduced from written down value of the block. Are you able to understand? That is the time. Stunt present, sir. Stunt, welcome. Good evening, Sinduri. Now, Section 35 AD, specified business. There are list of 14 businesses here. If you start these 14 businesses, in those 14 businesses, whatever the revenue expenditure and capital expenditure that you have incurred, total expenditure will be allowed as deduction under section 35 AD. Are you able to understand? Generally, in PGBP, revenue expenditure will be allowed as deduction in P&L account. Capital expenditure will not be allowed. But if you start these 14 businesses, okay, like hotel of 2-star or above category, hospital containing 100 patient beds, warehousing facility for storage of agricultural produce, warehousing facility for storage of sugar. These list of 14 businesses are there. We have discussed in class. So these, if you start these 14 businesses, in these 14 businesses, whatever the expenditure that you have incurred, whether it is revenue expenditure or capital expenditure, 100% of the expenditure will be allowed as deduction under section 35 AD. Are you able to understand? Now, before commencement of this business, let's say I wanted to start a hotel. Before starting the hotel, I incurred certain expenditure for building the hotel. Even before commencement of business also, whatever the expenditure incurred for specified business is there, whether it is revenue expenditure or capital expenditure, 100% of the expenditure is allowed as deduction in the year of commencement of business. I wanted to start 2-star hotel. In 2021-22, I started construction. In 24-25, construction completed. In 24-25, I started the hotel. From 21-22 to 24-25, whatever the hotel construction expenditure that I have incurred, total expenditure will be allowed as deduction in 24-25. Are you able to understand? 3 years time limit is not applicable. In scientific research expenditure, 3 years time limit is there. Na? That time limit is not applicable for specified business. So from 21-22 to 24-25, whatever the capital expenditure that I have incurred, total expenditure will be allowed as deduction in P&L account. Okay, but the only condition is whatever the capital expenditure that I have incurred, all that capital expenditure should be capitalized in the books of accounts. Are you able to understand? After commencement of business, whatever the expenditure incurred, again revenue expenditure, capital expenditure, 100% of the expenditure will be allowed as deduction except these three assets: land, goodwill, financial assets. Land is not a depreciable asset, so even though land expenditure on land is capital expenditure, it is not allowed as deduction. On goodwill, no depreciation will be calculated, so like goodwill expenditure will not be allowed. Financial assets, they are not relating to business now, so that's why expenditure on financial assets, that is also not allowed as deduction in P&L account. Yeah, capital expenditure before commencement. This point we have discussed it. Now, even before commencement of business also, if you incur any capital expenditure, 100% of the capital expenditure will be allowed as deduction in P&L account. Next, deduction under section 35 AD, it is available only under optional tax rates. If SSE is paying taxes under default tax rates, deduction under section 35 AD is not available. Next, specified business loss can be set off only against specified business profits. Specified business loss cannot be set off against non-specified business profits. So let's say hotel is there. In 24-25, I started hotel. So in that hotel, whatever the loss is there, that loss I can set off only against specified business profits. Even though opposite specified business is not eligible for deduction under section 35 AD. Sir, what do you mean by this, sir? In previous year, 2004-5, I started one hotel. In that hotel, there is profit 24-25, profit is 80 lakhs. In 23-24, I started hotel. There is loss of 45 lakhs. Now, whatever the hotel that I started in 4-5 is there, it is specified business. But is it eligible for deduction under section 35 AD? No. Whatever the hotel I started in 23-24 is there, it is specified business. It is also eligible for deduction under section 35 AD. Now the question is whether this loss can be set off against this profit. Yes, it is possible. That means what? If both are specified businesses, sufficient. Even though later business is not eligible for deduction under section 35AD, still losses of one specified business can be set off against profits of another specified business. Are you able to understand? Next, when you are incurring revenue expenditure or capital expenditure per person per day, if you are making payment, you should make payment by way of bank transaction. If you make cash payment, then that expenditure will not be allowed as deduction. Okay. Conditions for claiming deduction under section 35AD. See, if you want to claim deduction under section 35AD, whatever the business that you are starting, hotel, warehousing facility, cold storage facility, all these should be new businesses. Let's say in 1995, one hotel started. I acquired that hotel by way of amalgamation. So through amalgamation or reconstruction, if you acquire any business, then that business is not eligible for deduction under section 35AD. Only if you start a new business, then only 35AD deduction is available. Next, specified business, like whatever the plant and machinery that you purchase for specified business is there, out of total plant and machinery, 20% of the plant and machinery can be second hand plant and machinery. That means 80% of the plant and machinery should be a new plant and machinery, 20% can be second hand plant and machinery. Next, if you import any plant and machinery from outside India, even though it is second hand, it will be treated as first hand plant and machinery, subject to the condition on that plant and machinery no depreciation should be allowed in India previously. Are you able to understand? Then even though it is second hand plant and machinery, it will be treated as first hand plant and machinery. Next, once you claim deduction under section 35AD, again you cannot claim deduction under section 80 QQB, 80 RRB, 80 JJAA. That benefit is not available. That means what? If you claim deduction under section 35AD, again for you deduction under section 80 JJAA is not available, because those deductions are deductions in respect of certain incomes. So either you claim deduction under section 35AD or you claim deduction in respect of certain incomes. Both are not possible. Next, once you claim any deduction under section 35AD, double deduction is not possible in any other section, in any other section of Income Tax Act. Now, see, whenever you, let's say I started hotel business. In hotel business, I purchased 20 air conditioners. Total 20 air conditioners I will claim as deduction in first previous year. Now, I should use those 20 air conditioners in my business. If I sell those assets, whatever the sale proceeds that are received, those are treated as income in the P&L account. Are you able to understand? Now, I am having two businesses, hotel business, education business. I purchased 20 air conditioners in hotel business. Now, out of 20 air conditioners, 6 air conditioners I transferred from hotel business to education business. So, lock-in period is 8 years. When you purchase any capital asset, when you incur any capital expenditure for specified business, then that asset should not be transferred to non-specified business for a period of 8 years. Within 8 years, if you transfer any asset, okay, to non-specified business, then whatever the deduction that you have claimed earlier, that will be reversed and it is taxable as income in P&L account, and the date on which you are transferring it to non-specified business, till that period accumulated depreciation will be allowed as deduction. Okay. Section 35D, amortization of preliminary expenses. See, before starting any business, you will incur pre-incorporation expenditure. It is also called as preliminary expenditure. Whatever the preliminary expenditure that you have incurred, that preliminary expenditure is allowed as deduction under section 35D. But the benefit of preliminary expenditure is available only for Indian companies or resident Indians. For non-residents or foreign company, deduction under section 35D is not available. Are you able to understand? Now, whatever the preliminary expenditure that you have incurred, 100% of the preliminary expenditure is not allowed as deduction. So, what happened? In case of Indian company, in case of resident non-corporate SSC. First, I will explain resident non-corporate SSC. Whatever the preliminary expenditure that you have incurred, actual preliminary expenditure or 5% of cost of project, whichever is lower will be allowed as preliminary expenditure deduction. Whichever is lower is allowed as deduction. Even this is also not allowed as deduction in a single year. This is allowed as deduction over a period of 5 years. Allowed as deduction over 5 years in 5 equal installments. Are you able to understand? So you can see 5% of cost of project or actual preliminary expenditure, whichever is lower will be allowed as deduction. Even that allowed deduction, it is not allowed in a single year. It is allowed as deduction over a period of 5 years in 5 equal installments. In case of Indian company, preliminary expenditure is allowed as deduction in 3 steps. Step 1, 5% of cost of project or 5% of capital employed, whichever is higher you need to take. Step 2, actual preliminary expenditure. Step 3, allowable preliminary expenditure is equal to step 1 or step 2, whichever is lower. Whatever the allowable preliminary expenditure is there, that is allowed as deduction over a period of 5 years in 5 equal installments. Are you able to understand? Section 35 DDA, amortization of VRS expenditure. That means voluntary retirement scheme compensation. So if you incur any VRS expenditure, voluntary retirement scheme expenditure, generally you know, like employees take voluntary retirement, then they will go out of the organization. It is income to employee, expenditure to employer. So whatever the voluntary retirement scheme compensation expenditure is there, that is allowed as deduction over a period of 5 years in 5 equal installments, and VRS compensation expenditure is allowed as deduction purely on cash basis. It is not allowed as deduction on accrual basis. Whenever employer actually pays VRS compensation expenditure, then only VRS compensation expenditure will be allowed as deduction, that too over a period of 5 years in 5 equal installments. Next, deductions under section 36. Now, we will start with deductions under section 36. PGBP is such a big head. Revision itself will take hours. Now, section 36(1). Whatever the insurance premium is there, either for inputs or outputs. Inputs means raw materials, outputs means finished goods. So whatever the stock insurance that you have taken, 100% of the stock insurance is allowed as business expenditure. Similarly, if you incur any insurance for your building, that is allowed as deduction under section 30. If you take any insurance policy for plant and machinery, that is allowed as expenditure under section 31. Stock insurance expenditure, that is allowed as deduction under section 36(1). Next, for employees, employer has taken a medical insurance policy. Whatever the medical insurance premium paid by employer to employee is there, that employer on the name of employee is there, that is business expenditure to employer, and it is allowed as deduction under section 35 AD. Next, Life insurance premium paid by employer to employee, that is not allowed as deduction under section 36(1) but allowed as deduction under section 37. Okay, next, bonus or commission. See, bonus or commission, they are allowed as deduction only on cash basis. We will discuss 43B. In 43B, it is very clear. Bonus expenditure, commission expenditure, either paid to employees or directors, it is allowed as deduction strictly on cash basis. Okay. Interest on borrowed capital. If you borrow any money for the purpose of your business, why the purpose why you have borrowed the money, whether for revenue expenses or whether to purchase any asset, that is irrelevant. Whenever you borrow any money for your business, on borrowed money, if you pay any interest, such interest is allowed as deduction. The only condition is borrowed money should be used for business purpose. It should not be used for personal purpose. If you use borrowed money for personal purpose, then whatever the interest is there now, that is not allowed as business expenditure. Are you able to understand? Next, in case of sole proprietor business, whatever the interest paid on sole proprietor's capital is there, that is not allowed as deduction. Next, next, SSC must have borrowed money. Borrowed money should have been used for business or profession. Interest is paid or payable. That means what? Section 43B is applicable. Whenever you borrow loan from banks, scheduled banks, financial institutions, then you need to pay interest. Then only it is allowed as deduction. It is not allowed as deduction on accrual basis. If you borrow any loan from your relatives, then interest paid to relatives is there. That is also allowed as business expenditure. But whatever the interest that you have paid to relatives is there, on that section 40A2 is applicable. In case of genuine borrowings, let's say like during COVID, you borrowed money. Even though rate of interest is high, even though you paid higher interest, that higher interest is also allowed as business expenditure. Okay. For capital asset, if you have taken any loan, then whatever the interest that is there from date of taking loan up to the date asset is put to use, that interest will be capitalized, added to the cost of the asset. After asset is put to use, whatever the interest cost is there, that interest cost will be debited to P&L. Okay. Discount on zero coupon bonds. See, zero coupon bonds are always issued at discount and are redeemed at par. Let's say zero coupon bond face value 100 rupees, but today they are issued for 60 rupees. How much is the discount? 40 rupees. That means seller is selling it at 60 rupees. After 5 years, it will be redeemed at 100 rupees. What is the margin? 40 rupees. It is expenditure to issuer and income to the buyer of zero coupon bonds. Whatever 40 rupees expenditure to issuer is there, that is allowed as deduction on pro rata basis. That means whatever the life of zero coupon bonds is there, over life of zero coupon bonds, 40 rupees is allowed as expenditure. Okay. Employer contribution to recognized provident fund and approved superannuation fund. See, as per provident fund rules, every month employer from his side, he is required to deposit 12% of PF in the name of employee, right? Whatever the employer contribution to recognized provident fund or superannuation fund is there, that is also allowed as business expenditure and it is allowed as next. Employer contribution to NPS, we have discussed deduction under section 80 CCD. So whatever employer contribution to NPS is there, that is also allowed as deduction, but subject to the condition maximum 14% of salary. If employer contribution is up to 14% of salary, allowed as business expenditure. If employer contribution is more than 14%, up to 14% allowed as business expenditure, balance it is not allowed as deduction. Employee contribution. See, what employer will do? Employer will take employee contribution and on behalf of employee, employer will deposit money with recognized provident fund. So whenever employer takes employee money, okay, it is to be credited to P&L account. Whatever the employee money that is deducted is there, this should be deposited to provident fund authorities before 15 of next month. If these are deposited, whenever money is deducted, it is recognized as income. Whenever this is deposited on time, it is allowed as business expenditure. Otherwise, it is not allowed as business expenditure. Are you able to understand? Deduction of animals used in business. See, whenever you purchase any animals which are used as assets in the business, okay. Now, whenever you purchase any animals, in the year of purchase, that animal expenditure is not allowed as deduction. When in the year animal becomes useless or animal dies, or whenever you sell the animal, in that year whatever the sale proceeds are there, from sale proceeds you will reduce cost of animal, whatever the difference is there, that is allowed as deduction in the year in which animal becomes useless or animal dies or animal is sold. So whenever any animals are used for business, let's say mine is event management company. I purchased two horses for the purpose of event management. Okay, so if any new marriage people comes, I will give horse cart to them. For that purpose, I purchased horses. Now horses are asset in my business, but whatever the expenditure on horses is there, that is not allowed as deduction in the year of purchase. It is allowed as deduction in the year in which horse becomes useless or in the year in which horse is sold. Okay. Next, bad debts. Now, see, bad debts are allowed as business expenditure subject to satisfaction of two conditions. First of all, you should have recognized that amount as sales earlier. Let's say I have done credit sales. I recognized income, but debtor did not make payment to me. Then that is allowed as whatever the amount that I could not receive from debtor is there, that is allowed as business expenditure. That means to recognize bad debts as deduction, whatever the bad debt amount is there, that should be recognized as income in earlier years. Are you able to understand? So it should be incidental to business or profession. It should have been taken into account in computing income of the SSC in previous year. Such bad debt is written off in any earlier previous year. Two conditions. First of all, it should be recognized in earlier previous years. Second condition, in accounts, it should have been written off. Then only under income tax also bad debts is allowed as business expenditure. Next, like I took personal, like my friend asked me 10,000 rupees. I gave. My friend did not pay me back. That is not allowed as bad debts. That means personal nature of bad debts are not allowed as deduction. Only business nature of bad debts are allowed. That too, they should have been recognized as income in earlier years. Then only allowed as deduction. Otherwise not allowed as deduction. Next, provision for bad debts not allowed as deduction. Only actual bad debts are allowed as deduction. Next, bad debts must be revenue in nature. So if there are capital nature of bad debts, they are also not allowed as deduction. Debts of a discontinued business not deductible. Next, like in current year, I claimed bad debts. Later, there is recovery of bad debts. Recovery of bad debts is taxable as deemed profits in the year in which I get back the bad there is recovery of bad debts. Okay. Next, deduction of family planning expense. See, whatever the family planning expenditure is there, even though it is not business expenditure, still it is allowed as deduction under Income Tax Act. If family planning expenditure is of revenue nature, completely allowed as deduction. But if family planning expenditure is of capital nature, it is allowed as deduction over a period of 5 years in 5 equal installments. Another important point, family planning expenditure is allowed as reduction only for company SSCs. If SSC is other than company, family planning expenditure is to be disallowed. Next, if there is any unabsorbed capital expenditure on family planning, then the tax treatment is same as that of unabsorbed depreciation. Next, securities transaction tax, commodities transaction tax. See, if I hold securities as stock in trade, then whatever securities transaction tax that I have paid, it is allowed as business expenditure. If I hold securities as capital asset, then securities transaction tax is not allowed as transfer expenses. Same is the concept with commodities transaction tax. So whatever commodities transaction tax is there, like if I purchase commodities other than agricultural commodities as a capital asset, then commodities transaction tax is not allowed as transfer expenditure. If my main business is buying and selling of commodities, then they will be treated as stock in trade. Whatever the commodities transaction tax is there, then it is allowed as business expenditure. Okay. Sir Sambar from Guntur. Next, section 37, general deduction. See, any expenditure which is not allowed as deduction under section 30 to 36. Remaining all expenses are allowed as deduction under section 37. But some conditions are there. Any expenditure which is not allowed under section 30 to 36, only remaining expenses will be allowed as deduction under section 37. Because if any expenditure is already allowed under earlier sections, then there is no point. They are allowed as reduction as per respective sections only. Next, only revenue expenditure is allowed as deduction under section 37. Capital nature of expenditure is not allowed as deduction under section 37. Next, personal nature of expenditure, revenue expenditure, not allowed as deduction. Only business expenditure will be allowed as deduction under section 37. Expenditure should have been incurred wholly and exclusively for the purpose of business. Next, if you pay any penalty, penalty is not allowed as business expenditure. Explanation 1 to section 37. See, for any offense, if you pay any penalty, that penalty is not allowed as deduction. However, if penalty is in the nature of compensation, then that penalty will be allowed as deduction. Next, CSR expenditure. If you incur any CSR expenditure, that CSR expenditure is also not allowed as deduction under section 37. As per section 135 of Companies Act 2013, you need to incur CSR expenditure. Whatever the CSR expenditure that you have incurred, that CSR expenditure is not allowed as deduction under section 37. Next, expenditure incurred by SSE by an advertisement in any souvenir. See, whatever the advertisement incurred in any political party journal, political party pamphlet or souvenir or political party calendar is there, that advertisement expenditure itself will be treated as donation to political party. It is not allowed as business expenditure under section 37. It is allowed as deduction under section 80 GGB. Okay. So with this, like these are various examples. You can just go through these examples relating to section 37. Next, expenses not deductible under PGBP. Now we will start with section 40 series. First, section 40A1. We have already discussed. As per section 40A1, payer, any person who is required to deduct TDS. Payee should be either non-resident or foreign company. Payer, at the time of making payment to payee, payer is required to satisfy two conditions. Condition 1, payer is required to deduct TDS, and the TDS is required to be deducted on or before 31st March of previous year. Whatever the TDS that is deducted is there, deducted TDS is required to be deposited to government. Deposited to government on or before ITR due date. Only whenever these two conditions are satisfied, then only 100% of the expenditure is allowed as deduction. Otherwise, 100% of the expenditure will not be allowed as deduction. Sir, is it forever disallowed? No, it is not forever disallowed. In future, with regard to this transaction, whenever both the conditions are satisfied, in that year, again they will be allowed as deduction. Are you able to understand? 40A1A is same. As per 40A1A, payer should be payer must be any person who is required to deduct TDS. But as per 40A1A, payee should be non-resident. So, payer at the time of making payment to non-resident, payer is required to deduct TDS. Deducted TDS is required to be deposited to government. Then only it is allowed as expenditure. Otherwise, it is not allowed as expenditure. It is not allowed as. Are you able to understand? Otherwise, 30% of the expenditure will be disallowed. So, anyone who is resident in India at the time of making payment, if they are required to deduct TDS, they should deduct TDS before 31st March of previous year. Deducted TDS should be deposited to government on or before ITR due date. Whenever these two conditions are satisfied, 100% of the expenditure is allowed. Otherwise, 30% of the expenditure will be disallowed. Are you able to understand? 30% of the expenditure is will not be disallowed forever. Again in future, whenever both the conditions are satisfied, in that year again they will be allowed as deduction. Next, this point also I have discussed in regular class. I have also discussed in booster series. Now, let's say audit fees is paid to me, but my client did not deduct TDS. Now, what happens? 30% of the audit fees is to be disallowed to the client. Whatever 30% of audit fees that is to be disallowed is there, that will not be disallowed. It will be allowed as deduction when four conditions are satisfied. My client gave me audit fees. Now, I should disclose audit fees in my ITR. I should pay tax on the ITR. Are you able to understand? So I should pay tax on the audit fees received from client. Are you able to understand? And I should file my income tax return. That means payee should file income tax return. Payee should disclose income received from payer in the income tax return. Payee should pay tax on that income, and these three conditions are satisfied. A chartered accountant should give certificate that these three conditions are satisfied. If all the four conditions are satisfied, even though 30% of the expenditure is to be disallowed, still it will be allowed as deduction. Okay. Next. Section 40B, assessment of partnership form including LLP. What do you mean by this? What this section is all about? We have already discussed. In case of partnership firm, share of profit received by partner from a partnership firm is not taxable in the hands of partner. It is fully exempt in the hands of partner. Similarly, if any interest remuneration received by partner from partnership firm is there, such interest and remuneration is taxable under the head PGBP to the partner. Now, interest and remuneration is income to partner. It is expenditure to partnership firm. Now, such expenditure is allowed as deduction subject to satisfaction of some conditions. Sir, what are those conditions? First, I will explain conditions with regard to. Now, whatever interest on partner's capital, remuneration to partner's capital is there, these two are allowed as deduction only as per partnership deed. Only if partnership deed authorizes, then only as per partnership deed, interest on partner's capital and remuneration on partners, whatever is there, that is allowed as business expenditure. Otherwise, it is not allowed. Next, interest on partner's capital, remuneration to partners allowed as deduction only on prospective basis. That means the date on which amendment is made in partnership deed. From that date, whatever the interest and remuneration is there, only that interest and remuneration will be allowed as deduction. Third condition. Total interest is not allowed as deduction. Maximum interest allowed is 12% simple interest. Let's say 18% interest is paid to partners. Out of 18% interest, only 12% interest is allowed as expenditure in income tax P&L account. Balance 6% interest is to be disallowed. Okay. Next, if any interest is paid to, like interest paid to both working partners and sleeping partners is allowed as deduction, but whatever the remuneration paid to sleeping partner is there, that is not allowed as deduction. Whatever the remuneration is there, total remuneration is not allowed as deduction. Actual remuneration paid to working partners or remuneration based on book profits, whichever is lower will be allowed as deduction. So remuneration allowed is equal to actual remuneration paid to working partners or remuneration based on book profits, whichever is lower will be allowed as. Now the point is how to calculate remuneration based on book profits. Calculation was given. First you will calculate book profits. If there are no book profits, maximum remuneration allowed for all working partners is 3 lakhs. If there are book profits, if book profits are up to 6 lakh rupees, then maximum remuneration allowed is equal to 90% of book profits or 3 lakhs, whichever is higher. If book profits are greater than 6 lakhs, up to 6 lakhs, 90% of book profits or 3 lakhs, whichever is higher. On balance book profits, 60% of book profits will be allowed as remuneration to partners. How to calculate book profits? Very simple. You will take net profit as per accounts and you will add back remuneration. After adding back remuneration, you will do PGBP adjustments. Thereby you will arrive at net profit before remuneration and after PGBP adjustments. That is called as book profits. From book profits, if you reduce actual remuneration allowed, you are going to arrive at net profit as per income tax. Okay. Next, 40A2. These days I am taking continuous classes. That's why I need to keep myself hydrated. Next, section 48. What 48 says? If any excess payment or unreasonable payment made to relative or close associate is there, then that excess payment is not allowed as deduction. Excess payment is to be disallowed. Section 48 is applicable only in respect of expenditure. If you get any extra income from related person, that extra income is not required to be disallowed. Section 48 is applicable only in respect of expenditure. When you pay that expenditure to relative or close associate, then total expenditure is not to be disallowed. Whatever the excess expenditure is there, that is to be disallowed. Are you able to understand? So three conditions. First condition, yeah, condition number one, only in respect of expenses. That too, you should pay expenditure to relative or close associate. Third condition, total expenditure is not to be disallowed. Excess expenditure is to be. Sir, who is called a specified person? Because whatever the excess, like relative and close associate together we call as specified person. Whatever the excess payment made to specified person is there, that is to be disallowed. In case of individual, specified person means relative. Relative. Sir, who is called as relative? Here, 5 persons: spouse, brother, sister, lineal ascendant, lineal descendant. These 5 are considered as relative for the purpose of 40A2. So, whenever you make excess payment to these 5 persons, that is to be disallowed. Not only payment made to relative, if any payment is made to any person who, like any business in which either SSC or his relative is having substantial interest, for that business also, if any excess payment is made, that is not to be allowed as deduction, that is to be disallowed. Excess payment is to be disallowed. Next, in case of partnership firm, who is called as specified person? In case of partnership firm, partners are to be considered as specified persons. Any excess payment to partners, disallowed. Not only partners, relative of partners, if any excess payment is made to relative of partners, that is also to be disallowed. Not only relative of partners, any other business or profession, in which partnership firm, partner or relative of partner is having substantial interest. Relative of partner having substantial interest. Even they are also considered as specified person. For them, even if any excess expenditure is paid, that is to be disallowed. Next, in case of company, who are treated as specified persons? In case of company, first, directors are to be treated as specified persons. If any excess payment is made to directors, that is not to be allowed as deduction, that is to be disallowed. If any excess payment is made to relative of director, that is also to be disallowed. Not only director, not only relative of director, if there is any other business or profession in which either company or director or relative of director, if they are having substantial interest in that business, then for that business also, if any excess expenditure is paid, that is not allowed as deduction, that is to be allowed. Okay. Next, 40A3, this you already know. Per person per day, you should not make cash payment of more than 10,000 rupees. Per person per day, if you make cash payment of more than 10,000 rupees, then not a total expenditure, 100% of the expenditure is to be disallowed. Are you able to understand? So per person per day, if you are making payment of more than 10,000 rupees, 100% of the expenditure is to be disallowed. Give me 1 second. Today, income tax bill was passed in Parliament. Amendment bill. Daily confusion is there, no certainty. So, as per 40A3, per person per day, if you make cash payment of more than 10,000 rupees, it is to be disallowed. 100% of the expenditure is to be disallowed. Now, you claimed any expenditure on accrual basis in 22-23, but in 23-24, you have made payment in cash, but you already claimed deduction in 22-23 now. So, if you claim any expenditure on accrual basis, Later on, when making payment, if you make payment in cash more than 10,000 rupees per person per day, then whatever the expenditure that you have claimed in earlier years is there, that will be reversed and it is taxable as income. Are you able to understand? So bearer check, crossed check. These two, if any payment is made by bearer check or crossed check, it will also be considered as cash payment. Okay. Next, 40A3 is applicable for each expenditure separately. Let's say today morning I paid rent to Mr. Srinivas 8,000 in cash. Today only I paid interest to Srinivas 6,000 in cash. Total payment made in cash is 14,000 rupees, but for two different expenses. For each expenditure, 10,000 limit is applicable separately. Are you able to understand? Next, there are exceptions to 40A3. These are not that much important. You can study on your own. 43B, very, very, very important. So there are 6 expenses. Amount payable to government, bonus or commission to employees or directors. Next, leave encashment expenditure to the employer. Next, employer contribution to provident fund, employer contribution to welfare contributions, any expenditure payable to Indian Railways. Similarly, if you take loan from any public financial institution, state financial corporation, industrial investment corporation, scheduled bank, cooperative bank, NBFC, then whatever the loan that is taken from these people is there now, on that loan you are required to pay interest. That interest is allowed as deduction as per section 43B. So there are 6 payments. For these 6 payments, if you make payment in current year, allowed as deduction in current year. If you make payment in next financial year, in next financial year before ITR due date, if you make payment, then it is allowed as deduction in current previous year. If you make payment in next financial year, that too after ITR due date, then it is allowed as deduction on cash basis. So to claim these 6 expenses, what are 6 expenses? Like leave encashment expenditure, any amount payable to government, taxes, duties and all. Next, employer contribution to welfare contributions, amount payable to Indian Railways, bonus or commission to employees or directors, interest on loan taken from financial institutions, scheduled bank, cooperative bank, NBFC. All these are allowed as deduction only if you pay in current previous year or if you pay in the next financial year but before ITR due date, then they are allowed as deduction in current previous year. Otherwise, they are allowed as deduction only on cash basis. Next, section 43BH. This is applicable to micro, small, medium enterprises. So whenever goods are sold on credit basis, we have to check whether there is agreement between supplier and buyer. If there is agreement between supplier and buyer, then like maximum credit period allowed is equal to agreement between supplier and buyer or 45 days, whichever is earlier. So credit period agreed or 45 days, whichever is earlier, that is the credit period allowed. So whatever the allowed credit period is there, within that allowed credit period, payment should be made. Then only that payment is allowed as deduction on accrual basis. Otherwise, such payment is not allowed as deduction on accrual basis. It is allowed on cash basis. Sir, if there is no agreement between buyer and seller, if there is no agreement between buyer and seller, then in that case, if there is no agreement, in that case, maximum credit period allowed is equal to 15 days from date of acceptance. That means today I did credit sale. Excluding today, in next 15 days, buyer should make payment to me. Only if buyer makes me payment, it is allowed as deduction to buyer. If buyer makes payment after 15 days, then it is not allowed as deduction to buyer. Are you able to understand? It is not allowed as deduction on accrual basis, but it is allowed as deduction on cash basis. Next, see, uh, last some sections are there, 44AA, 44 AB, 44 AD, ADA and 44 AE. You can search my channel CA Umasankar Maganti. So I have done one series called Booster series. In this Booster series, you can see list. PGBP part 2 is there. So there are timestamps. Like if you want detailed explanation, you can go through these booster videos also. Okay. At any point of time, you got doubt about any particular section, you wanted more explanation about that particular section, then you can come to my channel. There is a playlist booster series. In those booster series, you can whatever the video that you wanted, you can pick it and you can watch. Now we will discuss 44AA, 44AB. 44AA, maintenance of books of accounts. This section answers three questions. What are the books of accounts that are required to be maintained? Place where books of accounts are required to be maintained. Period for which books of accounts are to be maintained. First, last question. Sir, how much period books of accounts are required to be maintained? They are required to be maintained for 6 years from end of relevant assessment year. 6 years from end of assessment year. If you calculate from end of previous year, it is 7 years. Next, second question. Sir, place where books of accounts are required to be maintained. Generally, books of accounts are maintained at place of business or place of profession. If there are multiple places, then books of accounts will be maintained at principal place of business or profession. If there are also branch offices, then books of accounts relating to branch offices can be maintained at respective branch offices. Okay. Coming to the question, what are the books of accounts that are required to be maintained? For this, like person is classified into three categories: notified professionals, business SSCs, and non-notified professionals. Those who are paying taxes under 44 AD, 44 ADA, 44 AE. Okay. Now, notified professionals means what? Like chartered accountant, advocate, lawyer, and doctor, interior decorator, film artist, company secretary. All these will come under notified professionals. So first I will explain about business SSCs and non-notified professionals. So those who are engaged in business and those who are engaged in profession other than notified profession. Okay. They have two criteria: income criteria, turnover criteria. Conjunction is or. That means what? Out of income criteria, turnover criteria, if any criteria is satisfied, they are required to maintain minimum books of accounts. If income criteria is not satisfied, turnover criteria is also not satisfied, then they are not required to maintain any books of accounts. Sir, what is income criteria? So in case of like exclude current previous year, take last 3 previous years. In last 3 previous years, for any one of the previous year, if total income in case of individual or HUF, if it is more than 2,50,000, in case of other persons, if it is more than 1,20,000, then they are required to maintain minimum books of accounts. Okay. Minimum books of accounts means ledger and cash book. For example, in last 3 previous years, for any one of the previous year, like for all 3 previous years, total income is less than 2,50,000, or in case of other persons, total income is less than 1,20,000. Then income criteria is not satisfied. Then we will check turnover criteria. As per turnover criteria, exclude current previous year. Take last 3 previous years. In last 3 previous years, for any one of the previous year, you have to consider for any one of the previous year, if turnover is more than 25 lakhs. Okay. In case of individual or HUF. In case of any other person, if turnover is more than 10 lakhs, then they are required to maintain minimum books of accounts. Here it is not 2.5 lakhs, it is 25 lakhs. Okay. Otherwise, they are not required to maintain any books of accounts. Next, in case of notified professionals, ignore current year. Take last 3 years. In last 3 years, for each year, if gross receipts are more than 1,50,000, then they are required to maintain books of accounts as per Rule 6B. So, in last 3 years, for any one of the previous year, if gross receipts are less than 1,50,000, then they are required to maintain minimum books of accounts. Are you able to understand? Sir, what are books of accounts as per Rule 6F? I am sorry, it's not Rule 6B, it is Rule 6F. So, as per Rule 6F, they need to maintain cash book, ledger, journal, carbon copies of bills. That means if they make any payment for expenditure, if the value of payment is more than 25 rupees, they need to maintain a bill. And if they receive any amount, if value of amount received is more than 50 rupees, then they need to maintain receipt. And vouchers and bills, carbon copies, all these are required to be maintained. In case notified professional is doctor, then he is required to maintain opening and closing stock of inventories. See, with the doctor also there are medicines available now. So what is the opening stock and closing stock of each medicine? Those details are required to be maintained, and at the same time case register. So like whenever any patient comes to the doctor, case register will be written. That case register is also required to be maintained by medical professional. Next, 44AB tax audit. Very simple. A client came to you, then you will ask him, in your business, whatever the, first of all, turnover, if business turnover is less than 1 crore, tax audit is not required. If business turnover is more than 1 crore, then you will ask the client question, whatever the cash receipts in your business are there, if cash receipts are less than or equal to 5% of total receipts, and whatever the cash payments are there, if they are less than or equal to 5% of total payments, if both these conditions are satisfied, then up to 10 crore rupees tax audit is not required. Otherwise, tax audit is required to be done. Let's say a businessman came to you. His turnover less than 1 crore. No tax audit. Okay. Businessman came to you. His turnover is more than 1 crore. Then you need to ask a question. If cash receipts are less than or equal to 5% of total receipts, and if cash payments are less than or equal to 5% of total payments, if both these conditions are satisfied, then if both these conditions are satisfied, yes, then up to 10 crores, no tax audit. Otherwise, up to 1 crore only, there is no tax audit. Simple, turnover less than 1 crore, no tax audit is required. Turnover more than 1 crore, then you have to ask him, in your business, if cash receipts are less than or equal to 5% of total receipts. In your business, if cash payments are less than or equal to 5% of total payments. Both conditions satisfied, then up to 10 crores tax audit is not required. If any one of the conditions are not satisfied, if both conditions are not satisfied, then tax audit limit is only 1 crore. Up to 1 crore, no tax audit. If turnover crosses 1 crore, they are required to get. Okay. In case of profession, we will consider gross receipts. If gross receipts are up to 50 lakhs, no tax audit. If gross receipts are more than 50 lakhs, tax audit is required. under section 44A. Next 44AD, 44ADA, 44AE. See, 44AD, 44ADA, 44AE, these three sections you can listen here. Like 15 minutes explanation was given. Please listen in booster series because I am done for today. 44AD, 44ADA, 44AE, they are simple only. Like till here I have revised those three sections. Please listen in the booster series. Okay. Thank you very much.